Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Brian Stutland, Managing Partner, Equity Armor Investments, and Mike Khouw, CNBC contributor and Chief Strategist at OpenInterest.Pro. We're here to discuss the curious case of the VIX. Before we get into that, we'll also take a look at recent fluctuations in the market and the factors influencing them, including rates, jobs, earnings, and of course, the potential impact of tariffs and policy execution. It's great to see you guys as always, Brian. Let's kick it off and discuss what you're seeing with the 10-year and relative to the Nasdaq's recent performance and the historical relationship behind that.
Yeah, I think when you look at the Nasdaq here, and it's sort of been bouncing around and sort of inserting this sort of consolidation pattern. If you take a look at the charts, really it hasn't been able to break above 22,000 on the Nasdaq 100 or below 21,000. And, it tends to struggle a little bit as rates turn higher. But when we look further down the road and we look at the 10-year rates, we've obviously seen them back off of their highs. And typically, at least over the last couple of years, when you look at the Nasdaq and interest rates sort of back and go lower, what tends to happen is the Nasdaq tends to break out of that consolidation pattern and move significantly higher. So I suspect if we can get the 10-year interest rates down to, like, let's say 4.25%, that could lead to a very nice rally in the Nasdaq and sort of this breakout of consolidation. Though on the flip side, though, obviously we had the unemployment report come out. We're talking about unemployment at 4%. That obviously is not great. We're seeing interest rates tick up. Maybe that's some headwind here in terms of what the Nasdaq can actually do. But certainly this consolidation pattern is something to watch and watch for that breakout to happen.
Yeah. And Mike, let's talk more about the jobs data. Explain to us how strong data can sometimes be interpreted as bad news for the market. It sounds like we're back into the cycle of good news is bad news and bad news is good news, or the inverse of such.
Yeah, I mean, it's often viewed as kind of a double-edged sword, right? So the unemployment rate at 4% suggests that the economy is doing very well. Most people are employed. People who are looking for a job can generally find one. When the unemployment rate is low, that can also mean that you get better aggregate incomes in general, and that can boost consumer spending, which is also a big part of economic growth. I mean, the consumer represents 70% of the U.S. economy. So if consumers are doing well, then presumably the economy is also doing well. The flip side of that comes in two forms, really. I mean, the first thing is that what is good for employees isn't always that great for employers. So if it's easy to find a job and you can demand higher wages, that means it can be hard to find labor and you have to pay more to hire them. So that's a little bit of a problem for business on the expense side. And of course, that can elevate production costs, and that can cause sort of a cost push inflation. I think that's one of the issues, of course, that people are looking at. The other side of it is that it has an impact on the value of financial assets because, we use something called a discount rate. So we take a look at what a business is going to do in the future, or a group of businesses, how much money they're going to make in the future, and we discount that back to a present value of some kind. And the higher interest rates are, the lower that number becomes. So, you have both of these two impacts. One is a potential inflationary impact, and one is basically associated with the value of the assets, of risk assets.
Yeah. And Brian, let's get into the curious case of the VIX. It's around 15 at this point, despite the market reaching all-time highs. Would you expect it to be at a lower level considering where the major indexes are?
Yeah, it's interesting. I mean, I talked about earlier in the show here that Nasdaq being this sort of consolidation pattern. And when you see the market consolidate, typically you'd expect the VIX to sort of trend lower, representing less and less moves. But really, when you dive deeper into these actual day-to-day moves, they're quite volatile. I mean, one piece of news that hits the tape and all of a sudden the markets are moving 1% in a different direction. So I think that level of concern, the level of jitteriness, I guess you could call it, around tariffs and are they going to get put in place? Is that just a negotiation tool or whatnot? I think has led the VIX to sort of stabilize around this 15 level. And if I was looking to be like a hedger or something, I'd probably look at around 15 VIX or maybe 14 VIX and say, hey, I want to own some hedge in my portfolio in order to just play this back and forth movement in the market. But really, I also spoke about interest rates. And when interest rates do come down off their highs, it's interesting that when you look at a VIX chart compared to the 10-year, as I kind of showed before with the Nasdaq, the VIX tends to actually sort of find a bottom and find a place where hedgers want to come in and maybe buy some puts just in case this interest rate move is wrong. And I suspect that's what's kind of happening as well.
Yeah, and like you had mentioned spending before as it relates to wages, I want to switch gears and talk about CapEx for a moment here. Google, Amazon, they revealed it in their earnings reports. And it's interesting because when you hear about companies investing in CapEx, which sets them up for future growth, the reaction to the stock isn't necessarily as positive. How do you think spending could be a positive sign for the future?
Well, I think there's kind of two sort of things that I would like to look at. So, I mean, Meta also basically came up with some pretty eye-watering CapEx numbers for the full year. So, Alphabet's looking at about 75 billion, Meta 60 to 65 billion, and Amazon $100 billion. And what's interesting is that we had this DeepSeek news come out a little over a week ago. I mean, that's actually when it impacted the markets. The DeepSeek release actually took place before that, and then we had Alibaba's release shortly thereafter, and that kind of hit that AI trade. People were wondering whether you could achieve similar results without spending the big money on the top-of-the-line NVIDIA GPUs. But, what we're seeing from these companies is that they are going to continue to invest and at a very robust pace, and they think this is where it's going to happen. So the first thing I would say is that from a hardware perspective, for those that supply them, including NVIDIA, I wouldn't start discounting your sales assumptions too much just yet, because the biggest buyers are obviously very interested in continuing their spend. If you can do more with less, you can do more than that with more. So I think that's kind of the logic. The other thing is that I think that there was kind of an underestimate of the technology that DeepSeek was using to achieve the results that they've got. I mean, obviously we have the conversation about whether or not they had access to more GPUs via Singapore and things like that. But I think the first thing it tells us is the AI trade is very much intact. So we should certainly expect that. I think that's one part of it. Obviously, I was a little bit surprised, actually, the impact on Alphabet's price in particular. I think it was, I think it's hit again today. I actually don't have it up on my screen at the moment, but this morning when I was looking at it, it was lower once again. I think investors are a bit too negative on Alphabet as well. It really. Some numbers were a little bit disappointing, but it had already priced in some disappointment. It was trading probably 3-4 turns cheaper than the S&P was. And this is a company that over the last decade has outpaced the S&P's growth on both the top and the bottom line considerably, massive free cash flow. So from my perspective, the story for both of those companies, actually probably all three, because I'll include Meta. You didn't ask me about it, but I'll just throw it in there, volunteer it, if you will. I think the AI trade is intact, and I think so is the story for these three businesses.
Yeah, Brian, I would agree with Mike's assessment as well as it relates to NVIDIA. Part of our coverage at CES was the discussion around the pendulum swinging back to hardware to support all of the software that's powering the tech revolution that we're seeing here. Secondly, Brian, it's for NVIDIA not to think about this, within their strategy longer term, that there could be other companies that can scale or be competitive within the landscape. I think that would, be foolish for anyone to assume that they wouldn't do that.
Yeah, and I think, Mike mentioned DeepSeek, and obviously that was a negative impact for NVIDIA stock when that news hit, thinking people are going to spend less. But then you see the earnings report, like Mike talks about, those CapEx numbers are just absolutely ridiculous. It's almost like a space race. And so we've seen NVIDIA's stock basically fall below 120 a share and all of a sudden rip back above there. So, I think the spending is not easing anytime soon. And, NVIDIA obviously well positioned in that space to do pretty well. I mean, full disclosure, all the names that Mike mentioned, we own for investors. I think the AI play still is in place for people. And yeah, these companies are going to need to spend. They're going to need to build this out. They need to get faster. They need to crunch more data. So we're at, I believe, still in the early stages. Let's call it like 95, 96, if I were to compare to sort of the information technology revolution that we saw with email when I first went to college, and it was like, oh, you can talk to your professor via email, and you're like, what is that? I think we're maybe just slightly past that in the AI play here. So, certainly it seems like that, the DeepSeek freak out was like a one-time event. And in fact, I'm almost skeptic of what that actually is. I've told our employees, don't download that thing on your system. It just seems too good to be true about that. So I think there's a lot of more positive to stay with the bigger player names.
And Brian, a quick derivative off of that, when you think about whether it's intentional or not data that's being shared on these generative AI platforms, when we think about agentic AI coming more into the picture, cybersecurity becomes another area that you want to focus on as well, because the more data you have, the more product you have, the more rush it is in a competitive landscape internally and externally to get these products to market. And I think we'll start to hear more about that as well when it comes to vendor exposure and vulnerabilities with all that data that's now out there. But staying, Mike, with the broader AI race and Palantir, it's not part of the Mag 7, but when you look at its performance, it kind of snuck in there when you think about the AI race.
I mean, at the pace it's going, it will be very soon. I mean, it is actually a remarkable story. It's a little bit difficult, admittedly, for me to get my arms around the valuation where it stands right now. I think I was looking at this yesterday, and it was something like 90 times full year on the revenue side. These are big numbers, but also big numbers are the pace of growth that we're seeing there. And I think when people, a lot of people who look at this company, I think they struggle to understand exactly what they're doing. And really, one way to think about it is this, which is you've got the big players in the AI space, like the ones we were just talking about, building out all of this technology. And then really Palantir, in many ways, you can think of it as a bridge between that technology stack and all of the various places that it can be deployed. So I think that's really quite impactful. I mean, I was taking a look, just for example, at one very small software that they are releasing, which is to the government, actually, as a lot of their contracts are. And it's basically a bridge on the EMP side. So if we think about the various places that companies like this get involved, it's displacing all kinds of things like legacy defense contractors, right? So you're going to have new technologies coming in on the hardware side, and Palantir is a bridge to, for example, EMP control, anti-drone, that kind of thing. This is just one small example. So it's hard to really overstate how big the total addressable market is for them if they're the ones that continue to dominate that space. I don't happen to own it, though, because the valuation is just really, really tough. It's got a lot of that priced in already.
Yeah, it certainly does. And Brian, the options market, anything you could see there that's interesting as it relates to Palantir?
Well, I think this is kind of a fun, interesting week for the stock itself. Obviously, earnings earlier, and then you have Friday after expiration, after an earnings week. You tend to get some decent amount of activity. It's no wonder that Palantir on Friday is trading around this 115 level. The Feb expiration of this Friday, the 115 calls are the most actively traded strike out of all of them, and have the most open interest. So it's almost acting like a magnet. So today might be a one-off, Friday one-off expiration kind of thing where the stock is moving to that big open interest strike as option traders reposition themselves. So it'll be interesting to see what the stock does come Monday and where it can move off this 115 level.
It's retail as well as institutional players that are trying to make these bets in this thing. Just yesterday, for example, the Feb 14th 110 115 traded 12,000 times for $1.25. That obviously is not retail. That was an outlay of $1.5 million in premium on a 1 week trade. They put that thing on when the stock was trading about $1.07. I think it's 114 now, so it's almost to that higher strike in just one day. Not a bad trade when you consider that they're probably up $3 million in probably 6 trading hours on this thing already. But yeah, it's wild. It's one of the busiest single stock options out there. I think on a notional basis, it was like 3rd or 4th yesterday.
Well, Mike, let's stick with that theme for a moment here, because we've been hearing more conversation in the marketplace, the impact of retail traders, particularly with more product available like zero-dated options. Do you think that is impacting market structure or any area of the market?
Well, it definitely is. I mean, one of the ways so here's one way to think about it, right? So if you have a question about whether or not, people are saying, oh, is the tail starting to wag the dog? I would say, which is the dog? I would, in many of these cases, the options are the dog and equity are the tails. Why is that? So in some cases, you have options contracts trading in terms of their share volumes 2 or 3x what the equity is. And don't forget, people who are market makers, this is what Brian and I used to do for a living for many years. If we're trading the option side, we're also hedging with the stock. And what that means is that a lot of the equity volume is actually being traded by the market making community as well. So that means that essentially options are the story, and the stock in many ways is just an afterthought.
Yeah, that's an interesting way to put it, Mike. Appreciate both of your insights. As always, thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.